Hey, and welcome to another video lesson on Skag Academy. In today's video, we're going to discuss the concept of liquidity. We're going to go ahead and define this, show a few examples of what liquidity looks like, and then from there, we will begin to explore it on the charts in further lessons. So let's jump right in, guys. What is liquidity? So liquidity, in short, is going to be very simply money. It's money that's sitting in the market, ready to be executed on in the form of limit orders, stop orders. This is also take profits and stop losses, right? Any sort of execute later, as well as all of the money of the individuals executing in real time, right? So liquidity is important because it gives us an idea of where the most money may be sitting at any time, and where the market knows money is located is where the market will want to go the most, right? Because the market wants to collect the most money. So liquidity builds up over time. The longer that price stays within a certain trading range, the more liquidity that will build up around it. We'll show you an example of that. But first, we're going to discuss structural liquidity and liquidity pockets. So structural liquidity is very simply money in orders that are sitting just above or below a single high or low. And a liquidity pocket is formed between 2 points of structural interest. So the examples that we have here on the left side shows you that structural liquidity, right? We could see we have that structure point on the left side, price goes down, and then price comes back up and starts to wipe that liquidity, whether those maybe be stop losses, whether maybe those are sell limits, buy stops, right? Whatever may be sitting there, there's money sitting above that previous structure. And then on the right side, we have the example of a liquidity pocket, right? It's a area formed between two structural points. It acts as a point of interest. It actually breaks one low but holds the other. This is why we call it a pocket. So as you can see, it dips below into that pocket, and that acts as an area of potential demand or supply if it was reversed. We're going to explore a lot of different situations where one of these may or may not be more useful than the other. Understanding liquidity pockets are actually very common in some of the schematics that we're going to go over, so you'll be kind of hearing about that a lot. Then we also have range or schematic or pattern liquidity. This is liquidity that is developed around a trading range or a schematic. This is actually built up over time, and this is creating stronger and stronger liquidity as time develops. Right? So the longer it sits here, the longer the market actually has to build up these orders, and then you have more money sitting there. Right? So this happens mostly during phase B. Through our schematics, we know that's actually when price is testing the upper and lower bounds of the schematics. And over time, this will actually get stronger. So what I want to show you is like an actual build-up example. This is just a mock-up example. We'll do a lot more examples using real data further in the course. But let's just say we experience a harsh push to the downside and the market begins to create a phase A environment, right? So as that range forms, orders do start to collect around the price action, creating areas of liquidity. We can see that little green line and the little red line, just signifying demand buildup and supply buildup outside of that phase A environment. And then as this range develops into phase B, we can actually see the liquidity increasing, which is visualized by those lines getting thicker. Again, we'll explore this, inside of real market examples. As price continues to trade within the range, eventually the market will move into a phase C environment and test the liquidity, and then how that reacts will tell us everything. There's a million different variations to this. There's all sorts of patterns and ways liquidity can build up. Remember, liquidity lives everywhere. What happens inside of that liquidity is very important. So liquidity will have a million different ways it can look. Will remain obvious to those who are trained to only trade inside of it. We will be exploring various case studies that'll break down the many faces of liquidity. These are some just, again, common examples, common chart patterns. You have pennants, wedges, you have just a very common accumulation pattern that's both testing a liquidity pocket and just overall liquidity. So there's going to be a lot of different ways we're going to explore this, but I wanted to familiarize you guys with the term because you're going to be hearing it a lot in the lessons going forward. So with that, that does wrap this up and this section of the course. If there are any, of course, there are any comments, concerns, questions, thoughts, leave them in the comments below the course or send a message in the Discord and I will answer those for you. Thank you guys, and I will see you in the next lesson.